So we know what stocks are, and we know how they trade. We're now up to a crucial question. Why do their prices change? Stock prices change every day as a result of trading in stock markets. The prices are subject to laws of supply and demand. If people want to buy a stock, then if there are more buyers than sellers available, its price moves up. If more people want to sell a stock than there are buyers for those shares, its price moves down. The more difficult part to understand is why people want to buy or sell a stock. Typically, the price of a stock is based on where people think its price will head in the future. There are many ways people set out to determine this. I explain various strategies in a following course. Some people believe looking at the past price holds the key to the future. Others believe looking at the business the stock is held in holds the key. Theoretically, earnings are what affects investors' valuations of a company, but there are other indicators that are used to predict stock prices. Remember, it is the sum of every single investor's sentiments, attitudes, and expectations of future prices that ultimately determines a stock's current price. No one knows for sure why a stock's price is changing, but one thing is certain. Stocks overall offer the best returns for an investment, and that is why so many people trade them. The most important takeaway from this lecture is that stock prices are run by the laws of supply and demand. Due to the market being determined by humans, the supply and demand can present opportunities for profit. These opportunities are why investors spend their time and money trying to determine where a stock price will be in the future. There are many ways to determine where the price will be.